Welcome back, and thank you for joining us. You're watching GBC World News. I'm David Parra. In business, Nissan beats analysts' expectation by posting an operating profit of $2 billion for the April-June quarter. Aggressive China expansions plans to stay ahead of rivals.
Automaker Nissan reported a much smaller than expected 10% fall in quarterly operating profit Wednesday thanks to a swift post-quake recovery and aggressive expansion in China. Japan's second biggest automaker posted an operating profit of $2 billion for the April to June quarter, way above analyst expectations for earnings of $1 billion. With Toyota and Honda set to post quarterly losses, Nissan is poised to further outshine its Japanese rivals as it moves to double its output in China by investing $8 billion by 2015. Nissan is already the largest Asian automaker in China, but the Japanese firm is further accelerating its expansion in the world's biggest auto market. Nissan currently has a 6% share in the Chinese market, leading Japanese rivals Toyota and Honda. Now, Nissan aims to capture a 10% market share in China to catch up with international rivals such as General Motors and Volkswagen. Nissan's Chinese joint venture, Dongfeng Motor, plans to launch about 30 new models in the next 4 years, including an electric vehicle under the brand name Venucia.
The yen hits a 4.5-month high, and gold touches a new record on U.S. debt ceiling problems. Stanchart says China cannot sell U.S. treasuries.
The Japanese yen rose to a 4.5-month high against the dollar, and gold hit a new record Wednesday amid a lack of progress on the U.S. debt ceiling problem. Analysts say a stronger move by the yen was only tempered by fears of intervention from Tokyo. Japanese policymakers are reportedly considering short-term intervention to stem the persistent rise in the yen. The Australian dollar also rose to a 29-year high after second quarter inflation numbers effectively ended market speculation of a rate cut by the Australian Central Bank. Asia-Pacific currencies have already been rising as traders anticipate more action by policymakers to keep inflation at bay. HSBC's Gary Evans also expects capital inflows to return to the region as investors take refuge from debt crises in the US and Europe.
In the next 6 to 12 months, the concerns are going to shift rather more towards growth. People will worry about whether growth in the developed world is going to continue, and they'll worry about global cyclical growth. And if you look at some of the markets like China, but also India and Brazil, I think people will start to say, well, growth is fine, inflation is no longer a risk. It's actually, as a risk and reward balance, China and these other markets start to look more interesting.
Asian stocks traded mixed Wednesday as investors continue to hedge by buying gold. But recent risk-related sell-offs have been measured, with many investors aware of the political nature of the U.S. crisis. Standard Chartered Stephen Green adds large international investors, including Beijing, have few safe alternatives to the U.S. Treasury market.
FX reserves are still rising. They're rising at about $30 to $40 billion a month. What do you do with that cash? You can't really, there are two places to park that amount of cash, and it's in the euro and US debt markets. So that's one consideration. The other consideration is that if China started to sell its treasuries, and the fallout on the value of the dollar and in the US debt markets would be huge. And so China knows it cannot really sell its US holdings.
Japan's Nikkei fell about 0.5% but stayed above the 10,000 level, supported by expectations of firm corporate earnings. Sydney stocks ended lower amid fears the Reserve Bank of Australia could hike rates sooner than expected. Shares in Hong Kong traded largely flat, while Shanghai stocks rose in late afternoon trade.
Here are a brief summary of business headlines. Downgrade concerns are in focus on Wall Street as stocks end lower. Amazon sales surge and UPS beats forecast as housing prices stabilize in May.
Experts are starting to put a dollar figure on the possible economic fallout if America loses its AAA credit rating. Economists say it will cost the U.S. $100 billion in additional interest payments and hurt both consumers and the economy. Some on Wall Street say Washington will avoid default but may not avoid the downgrade. Tom Roth is with UBS.
The expectation is that the deal will be a short-term deal. to get us through the next presidential election, and will ultimately not solve any of the longer-term problems that we have from a fiscal deficit perspective. And what that essentially means is that there's a likelihood, I think at this point, that we do see a downgrade of the long-term Treasury rating of the United States.
In the latest earnings update, sales at Amazon.com surged a better-than-expected 51% last quarter, and profits, though down from a year ago, still topped forecasts, even as the company spends more to grow its digital media business. Results out of UPS came in just above forecast, but the company says Washington's debt stalemate is hurting business sentiment. Wrapping up the day's economic numbers, single-family home prices in 20 metro areas were flat in May on a seasonally adjusted basis compared to the prior month, but still down from a year ago, according to the S&P Case-Shiller Index. Meanwhile, the Commerce Department says new home sales fell 1% in June, and consumer confidence ticked up this month, according to the Conference Board. As for Wall Street, the Dow lost ground for a third day in a row with consumer stocks a big drag. European markets finished mixed as they did a day earlier.
Britain's economy only grew 0.2% in the second quarter, partly due to the royal wedding and Japanese tsunami, raising pressure on the government to boost growth as it tries to cut down the budget deficit.
It was a memorable day for many, but it seems the royal wedding has cost the UK dear. Britain's economy only grew by 0.2% between April and June this year, and industrial output shrank. That takes the annual growth rate to 0.7%, the lowest since the first quarter of 2010. And the Office for National Statistics says it's partly due to the wedding.
There was the bank holiday, the public holiday associated with the royal wedding. There were the after effects of the Japanese tsunami, and also the effects of record warm weather in April. Our overall broad brush and illustrative analysis suggests that they may together have subtracted around 0.5% of GDP.
The sluggish economic recovery is putting more pressure on the British government to boost growth while they're trying to cut the country's budget deficit. Opposition parties say the government is cutting too fast, but Prime Minister David Cameron says there's no plan B.
This year, Britain's budget deficit is bigger than Greece's. The reason we're not in the mess that Greece is in is because we have a plan, and because while interest rates in Greece are over 10%, ours are around 3%, because the government has a plan to get on top of our debts. The world knows that, business knows that, investors know that.
While business leaders are generally in favour of cutting the deficit, Peter Bishop, Deputy Chief Executive of the London Chamber of Commerce and Industry, says many firms are looking abroad in order to grow.
Domestic activity is down. There is certainly in London indications that export activity, foreign trade activity is up, partly of course because the home market is slow, but partly as well because bad times it makes innovation thrive.
I'm David Parra. You've been watching GBC World News, a broadcast from Houston, Texas. Make sure to follow us on Twitter or like us on Facebook.